All right, let's talk Chatham Lodging Trust. After their latest earnings call, the stock gets a nice little bump. But here's the weird part. One of their most important performance numbers was actually down. So what's the deal? We're going to break down their quarter, dig into their strategy, and figure out what it all means.
So, on the day they reported earnings, Chatham stock gets this modest pop, right? It closes up 1.5%. But, and this is the real head-scratcher, their RevPAR, that's revenue per available room, a super important metric in the hotel biz, was actually down a bit. So what on earth did investors see that made them buy the stock? It clearly wasn't in the big headline numbers.
Okay, so here's the game plan. We're going to look at the headline beat, then go beyond the numbers to the strategy. We'll check out a tale of two very different markets, see what their guidance is telling us, and then, of course, wrap it all up with our take on the next call. Let's dive in.
First things first, let's look at those headline numbers. Because really, every earnings report boils down to one simple question at the start. Did they beat the street? Let's see how they stacked up. And this right here is the heart of that puzzle I mentioned. Check it out. They beat expectations on adjusted FFO, which, is a key profitability measure for a real estate company like this, and they also beat on revenue. But look at that last line. RevPAR year over year was negative. Beating on the bottom line while a core operational number is slipping, that is what got Wall Street's attention.
So when you see the stock go up on a day with mixed numbers like that, it's a huge signal. It tells you the market isn't just looking at this quarter. Nope, they're looking past it, at a really big strategic shift the company's making. And that strategy? It's a super clear 3-step plan. Step 1, sell off the older, underperforming hotels. Clean house. Step 2, take that cash and use it to hammer down debt, making the company financially stronger. And step 3, and this is a big one, they've started buying back their own stock for the first time ever. It's a classic smart playbook. Trim the fat and reward your shareholders. And you don't even have to take my word for it. The CEO, Jeff Fisher, laid it out plain as day on the call. He's saying, look, we're selling these hotels, and we're not just sitting on the cash. We're going to use it to buy better hotels or buy back our own stock. It's all about that smart capital recycling, putting money where it's going to work hardest. And what's the result of all of this discipline? Well, here it is. Their leverage, basically their debt level as a percentage of their assets, is down to just 21%. Now, in the real estate game, that is a rock-solid balance sheet. Seriously, it gives them a ton of financial flexibility, a war chest to go out and buy things or repurchase more shares, especially when their competitors are strapped for cash.
Okay, so let's shift gears now to the actual operations. Because if you just looked at that flat RevPAR number for the whole company, you'd miss the real story. Underneath the surface, there was a huge divergence in performance across their different markets. I mean, on one side of the coin, you've got Silicon Valley, which is their biggest market by far. And it was on fire. RevPAR there was up a solid 3%. That was all thanks to booming demand from the tech industry. That one market was basically carrying the whole portfolio on its back. It really shows you the core of their business is healthy.
But on the flip side, they got hit with some really specific and I think temporary issues elsewhere. In Dallas and Austin, things were weak simply because the big convention centers are shut down for renovations. And get this, in Seattle, they saw a 47% drop in Canadians driving over the border. That's huge. But the key thing to notice here is that these don't seem like problems with Chatham's hotels. They're external factors that should eventually go away.
So, okay, you've got this picture of a strong core market being dragged down by a few temporary problems. So the big question is, what does that mean for the rest of the year? What's management telling us to expect?
Well, the guidance they gave is fine, it's stable, but nobody's popping champagne corks over it. They're basically saying for the full year, RevPAR will be somewhere between flat and up just 1%. And FFO will be in a pretty tight controlled range. So the message is pretty clear. Expect a steady but not spectacular second half of the year.
So if the day-to-day operations are just going to be steady, then the real juice for the stock is going to come from these catalysts right here. This is what we need to watch. Will they get more aggressive with that share buyback? Will the newly renovated hotels in Austin and Mountain View give them a nice little boost? Can they catch a tailwind from a broader comeback in business travel? And of course, with that super strong balance sheet, you always have the wild card of them making a really smart acquisition. Okay, so let's put it all together. You've got this great strategic cleanup on one side and a kind of meh operating outlook on the other. How do you balance those? Here's our final verdict.
We're calling the narrative here the cleanup to compounding story. Think about it.
The first phase, the cleanup phase of selling off weaker assets and fixing the balance sheet. That's pretty much done. Now they're entering the compounding phase, where they can use that clean foundation to start building real long-term value for investors, whether it's through buybacks or savvy growth.
So, with that story in mind, we're rating the stock market perform. Look, the strategic moves they've made are fantastic, and that balance sheet is a huge plus. But right now, those positives are being held in check by that pretty flat guidance. For us to get more excited, we really need to see one of those catalysts we talked about start to kick in and drive the numbers higher. But this whole transition from fixing the past to building the future, it's a really interesting moment in a company's life. And for investors, it creates a pretty unique opportunity, a specific trade idea, if you will. We're calling it the discipline pairs trade. And the idea is pretty straightforward. You're betting on Chatham's smart management and financial discipline. So you go long Chatham, and at the same time, you short one of their competitors, maybe one with a messier balance sheet and a less focused strategy. The bet is that the gap in performance between these two companies is going to get wider and wider as Chatham uses its strength to pounce on opportunities. Now, what's the risk? Well, a big recession could sink all boats, right? Or the company you shorted might suddenly get smart and start its own cleanup plan, which would ruin the trade. And as always, this is not financial advice.